So what does your credit and income have to look like in order for you to get a VA loan in 2024? I'm going to be answering those questions and more here in the second installment of the VA Loan Guide for 2024. Stay tuned. Let's unpack one of my favorite things to talk about when it comes to VA lending: credit scores and overlays. Now, VA loans do not have a minimum credit score, but that does not mean that your credit score doesn't matter or that your credit report, the data on it doesn't matter. It matters very much in determining whether or not you can get a loan. Now, lenders reserve the right to mandate a minimum credit score, but that's something that's going to vary from lender to lender. You need to be wary of any lender that tells you, hey, the minimum credit score for a VA loan is X. And there are a lot of lenders out there that do this. Even one that is you probably have heard of that has the most marketing and branding towards veterans, that in my opinion is the worst place to get a VA loan. These rules, these made up rules, are called overlays. And I want to talk to you briefly about what an overlay is. The VA mandates the minimum requirements and qualifications in order to get a VA loan, and it is published in the VA handbook, and it's public record information. You can go on Google and download a copy of it and be reading it here in just a minute if you wanted to. But lenders reserve the right to layer additional rules on top of the VA's guidelines. And these rules are called overlays. And these are the in-house rules that a lender has in addition to the VA's rules that mandate what they will and will not do. And lenders have the right to be more restrictive than the VA. They just can't be more lenient than the VA. So if the VA says, hey, at a minimum, a loan has to have this, a lender can't go against that, but a lender can say, well, actually, with our firm, we're going to require even more than that. I say you should try to stay away from lenders that have an abundance, if any, overlays on VA loans, because they only serve to be more restrictive and stop veterans from getting homes. Overlays never make it easier for you to get a loan. And there are a lot of companies that have credit score overlays where they come up with these arbitrary numbers and say, hey, you have to have at least this. I promise you, you can read the VA handbook cover to cover. You will not find a minimum credit score. That is not something that they have. When you apply for a loan, lenders are going to look at all three of your credit reports from all three of the major credit bureaus. And they're going to use whichever score falls in the middle. So your median credit score becomes your qualifying score. If for some reason you don't have three credit scores, and they'll just use the lowest of the two, which sometimes happens with veterans that don't have a lot of things reporting on their credit report. If you're the guy that typically uses cash for everything, you may find that you don't even have three scores. So in that case, they'll use the lowest of the two. Do not be alarmed by lenders who say the minimum credit score to get a VA loan is 620 or 640. You shouldn't be shocked at all when you hear that. You should just keep looking though, right? There's plenty of them out there. And again, they have the right to do this. Where it gets aggravating for me is when they tell you that that's the VA's minimum, instead of telling you the truth that that's their minimum and it's not the VA's, and that, you can likely still get a VA loan somewhere else, just not with us. I'll tell you what you're likely to see, even from some of the most veteran-friendly lenders out there. Applications approved for $0 down for veterans who have credit scores above 580. And if you have a score that's close to 580, it probably needs to be strong in some other areas in order for you to be approved with $0 down. For folks that have credit scores, say, between 520 and 580, you're likely going to need to put 5 to 10% down in order to get approved. Now, once your score starts to dip beneath that 520, 500 range, you're going to find it's nearly impossible for you to get approved. But I want you to understand, it's not because of the score. It's because what the score likely implies. If you have a credit score that low, odds are you have not been credit clean for the last 12 months. And the VA places a lot of value on being credit clean for at least, the last 12 months. And what does that mean? Basically, all that means is that you have not incurred any new derogatory marks on your credit score for the last year. So the VA knows that, hey, life happens. People have financial hardships. People get behind on bills. It happens. But the VA wants to see that, after that's happened to you,
that you've resolved whatever issue was causing it and you're back on the right track now and you haven't missed payments on anything for at least the last year. You will likely never find a credit report that has a score as low as 520 that's been credit clean for 12 months. You're just not likely to see that. So it's less about the score and more about what's actually happening on that credit report that's producing that score. Now, despite the fact that you can definitely get a VA loan with credit scores in the 500s, you should be mindful that your credit score will impact your rates and pricing, and thus the affordability of the loan in the home that you want to buy. So for all you folks out there that don't have a credit score that's at least 740, I encourage you to go to my channel and watch my credit hacks video. I'm going to be exposing some secrets about your credit score that you never knew. I'm going to be breaking down exactly how your score is calculated. And then through use of that knowledge, I'm going to be sharing with you some strategies that you can use to exploit that formula and add some serious points to your score in a relatively short period of time. So definitely, if we're not working with a 740 plus score, go to my channel, watch the credit hacks video. That's going to be super beneficial for you. Let's talk about how some major credit events can impact your ability to get a VA loan. If you have had a Chapter 7 bankruptcy, it can be disregarded if it's been 2 years from the date it was discharged. If it's been less than 2 years, then you as a veteran will need to have reestablished positive credit, at least over the last 12 months. And the bankruptcy must have been caused by circumstances that were beyond your control. So when we talk about establishing positive credit, it means you went through bankruptcy, but since then you've acquired some new accounts and you've had them for at least a year and you haven't had any derogatories. You've been paying everything as agreed. And when we talk about it being a situation that's outside of your control, VA is far more lenient with this rule than some other loan products. You know, the VA considers, you being laid off a factor that's outside of your control, whereas some other loan programs would not. But divorce is one of those things that is kind of universal in lending. That is not considered a situation that's outside of your control. So if your bankruptcy was a result of the dissolution of your marriage, you won't be able to use that as a factor to get past some of these wait periods. Chapter 13 bankruptcies are a little bit different. These are not necessarily a barrier if you are making all your payments satisfactory. A Chapter 13 bankruptcy is when you're making payments through the court and it's being divvied out through your different creditors. If you have made at least 12 payments towards your Chapter 13 bankruptcy and you have paid them all as agreed and you get the permission from the judge or the trustee of the bankruptcy, then you can actually proceed with a loan application while being in bankruptcy with VA. Previous foreclosures are actually treated in a similar fashion as bankruptcy. They can be disregarded if it's been at least 2 years since it happened. And if it's been less than 2 years, then you need to have established positive credit over the last 12 months. And the foreclosure must have been caused by an event that's outside of your control. So very similar to Chapter 7 bankruptcy. And for deed in lieu and short sales, you actually may not have a waiting period. If your mortgage payment history isn't terrible and you were in voluntary communication with the lender and it was a voluntary deed in lieu of foreclosure, then you may not have to wait at all. But that being said, foreclosures, deed in lieu, short sales, those things can impact your entitlement if the VA has to pay out some of that guarantee. So be mindful, having gone through one of those major credit events may have impacted your entitlement and thus how much money you can spend on a new place with a VA loan before you have to start making a down payment. Student loans. So I told you previously that VA had the most lenient calculation when it comes to student loans. So let's talk about when this would come into play, and then we'll look at some numbers and I'll show you how it works. So a lot of folks are on forbearance, or maybe they've deferred their student loans, or maybe they're on an income-based / income-driven repayment plan. And based on their income, the student loan lender has placed their payments at $0. When you are getting a mortgage loan, lenders know that when they pull your credit and they see student loans, if the payment says $0, it's not going to stay that way forever. So they know at some point you're going to have to start making payments towards this loan, theoretically. I know that, if there's some savvy student loan borrowers out there that find ways to keep that payment at bay for a long, long time. But theoretically, you're going to have to start paying them at some point. So what lenders do is they have a calculation that they use to determine what they think your payment may be. And then that's what gets factored into your debt to income ratio. So that is when this would happen. If they pull your credit and you have student loans, but there's a certain payment amount reporting for each of those student loans, then that's what they'll use, which is kind of crazy. If someone has income-based repayment and the income-based repayment is $0, they're going to use this calculation. But if the income-based repayment was $10, they would just use $10. They wouldn't bother you at all. So kind of silly. It probably needs to change at some point, but currently this is the way it works. And again, with VA, it's the most lenient of all. So the VA calculation for student loans is simply this. They're going to take 5% of the balance and divide that by 12 months. And that is your qualifying payment. So let's see what that looks like using real numbers. Let's say that your student loan balance is $84,000. Well, 5% of that is $4,200. And what they would do is they would take that $4,200 and divide it by the 12 months of the year, and your student loan payment would be $350. Now, to give you a comparison, with a lot of other loan programs, FHA, it used to be 1%. Other loan programs, it's 0.5%. I believe it's 0.5% now for FHA. So 0.5% of $840,000 would be $420. So that VA payment is considerably lower for student loan calculations than it is for any other loan program. But that being said, the recorded payment on the credit report must always be used. So again, if there's a payment amount that's not $0 that's listed on your credit report, then that's what has to be used, and that's what will be used to determine your debt to income ratio. For some of you folks out there, you may be in a situation where you're paying more than what this VA calculation is, and then if that's the case, then that's what's going to be used. So let's chat about work history for a moment. 2 years of consistent employment is ideal. I want to make this clear. Consistent employment and a consistent employer are not the same thing. I've done loans for people that have had 7 different jobs over the last 2 years. It's actually fairly common in some career fields. Like, for example, say someone works in construction. Hey, a guy has been a foreman for 7 different construction companies over the last 2 years. Well, if he hasn't had any large gaps in employment, he stayed consistently employed for 2 years, albeit by 7 different employers, that guy is going to be just fine. He has shown that he can stay consistently employed, and that's really all that matters. It's also important for veterans to know that schooling or training can kind of count as employment time. So, for example, if you are currently a registered nurse and you've only been a registered nurse for 6 months, but prior to you being a registered nurse, you were going to school to become one, well, that time you spent in school counts towards that 2-year employment history factor. Some of you may not be employed, some of you may be self-employed. Well, the same rule kind of stays in place. You still want 2 years of self-employment history, and typically with the same business, which is easy enough to show just by supplying a couple years of tax returns. Now, this is an employment rule that's actually unique to the VA loan program. Newly separated veterans typically need a year on the job. So if you have not been out of the military very long and you're working your civilian job now, you may need to be there for a year before you can use that income to qualify. Now, what are the exceptions to that 1 year on the job rule after leaving the military? Well, one of the exceptions is that the job you're doing now in the civilian world is relative to the job you did in the military. So, for example, if you were a crew chief and you worked on jets while you're in the military, and now you are working for the airlines as an airplane mechanic, well, it's kind of the same thing. So that waiting period won't so much apply to you. Another time it won't apply is if you were doing training for that job. So maybe when you were in the military, you were a cook, and now you are working as a registered nurse, but while you were in the military being a cook, you were going to school to become a nurse. So now at that point, the training fills in the gap. So if you were training for that position or going to school for that position before you got out of the military, or if the position is similar to what you did in the military, then the 1 year rule won't apply. But if you got out of the military and you're doing something new, you likely need a year on the job before you can use that income to qualify to buy a house. If you're an active duty veteran looking to get a VA loan, you need to have at least 12 months left on your contract. If you don't have 12 months left on your contract, there's a few different things that you're going to need. You'll need some documentation showing that you have already re-enlisted or extended your contract. If you don't have that, you'll need verification of, say, military retirement. If the reason you're not going to be there for the next 12 months is because you're retiring soon. You'll need a valid offer of civilian employment. If, let's say, you're not retiring, you're just separating from the military and going to pick up a civilian job, then you're going to need your offer letter from that civilian job. If that's not the case, you're going to need a statement saying that you plan to re-enlist and extend your contract. And you're also going to need a statement from your commanding officer saying that you should be eligible to re-enlist or extend your contract. If you're going to have a hard time providing any of these things, then you really need some strong underwriting factors, and that can be the difference in pulling you across the finish line. And strong underwriting factors are things like having a down payment, 10% down out of your own funds, not gift funds. Or do you have a lot of reserves? A month of reserve just means you have an amount of money saved that is equal to 1 month's mortgage payment. And when I say money saved, I mean money that you'll have after closing, not money that you'll be spending at the closing table. So for example, if you have $10,000 in your savings account and that's all the money you have, but you have to bring $5,000 to closing, then you really only have $5,000 in reserves because you're going to be spending half of your $10,000 at closing. So having 6 months worth of reserves, 6 months worth of mortgage payments stashed away somewhere that you won't have to spend to get into the house at closing, that's a strong underwriting factor. Or having spouse income that's really strong and just will require minimal income from you in order to make the loan work and for you to have a favorable debt to income ratio and good residual income. So strong spouse income, a little bit of a down payment, 6 months of reserves, those are strong factors that can help pull you across the finish line if you don't have some of the other items that would be helpful for an active duty member that's going to be leaving service in less than 12 months. Let's take a minute to talk about down payments. VA loans do not require down payments most of the time. Sometimes they do, and I'll explain that here in a moment. But down payments are not to be confused with closing costs. VA loans do have closing costs. They just don't require a down payment. Now, lenders reserve the right to require a down payment if you have lower credit scores or there's something unfavorable about your loan application that they don't like. They may ask you to make a down payment. Once your score starts to dip, I would say beneath the 580 range, you may find it hard for you to get approved by a lender without putting maybe 5 to 10% down. But with that being said, a 5 to 10% down payment can considerably lower your VA funding fee. So if you want to eliminate some of the costs associated with using the loan program and you're not a disabled veteran, then having a down payment is one of the ways to do that. Now, I know I said that there are times when you need a down payment, so let's kind of talk about that. If you're short on entitlement, you may have to make a down payment to purchase the house. So let me give you kind of the formula you can use to figure out if this applies to you. Now, the calculation for this is actually super simple. All you're going to do is take 25% of the purchase price of whatever home it is you want to buy. And that is the entitlement that will be required to purchase that home with $0 down. And what you're going to subtract from that number is the current amount of entitlement you have. And that leaves you with the amount that you have to put down. Now, for most veterans, that number is always going to end up being zero, because if you have full entitlement, you have unlimited entitlement. So it doesn't matter what 25% of the purchase price is, you got it covered. But if you're a veteran that doesn't have full entitlement, then this may be an issue and you may find yourself needing to put some money down. So let's use an example with some numbers so you can see what this looks like. If the house you want to buy is $500,000, 25% of that is $125,000. That is how much entitlement you would need in order to buy this house with $0 down. But what if your remaining entitlement is only $110,000? Well, there's a $15,000 difference, and that $15,000 difference becomes your down payment. Now, is $15,000 a lot of money? Yes, but $15,000 is only 3% of $500,000. And a 3% down payment on a $500,000 home is phenomenal, especially if you don't have to pay mortgage insurance and you're getting a rock solid rate. VA is still hands down the best loan program, even in this situation. Another time you'll need a down payment is when you have a non-veteran, non-spouse on the loan. And we will talk a little bit more about this in the co-borrower section, but a non-veteran, non-spouse does not qualify for the VA guarantee, which means they will have to put down 25% of whatever their portion of the loan is. Now, you can always put money down in any scenario. It's just not always required. So remember that about down payments. It is a zero down program for the most part. But if you have money you want to put down, you're always welcome to do that. And it can have an impact on your pricing. It can have an impact on your funding fee for sure. So it can be a worthwhile thing to do if you have it.
If you want to have a free one-on-one consultation with me to get all your VA loan questions answered, please go to VALoansWithEd.com and request a call from me. If you haven't seen part 1 of the VA Loan Guide for 2024, I suggest you definitely go back and watch that. And if you have, then I guess it's time for you to move on to part 3. We'll see you there.